Very good morning, dear boys and girls. I hope you will enjoy the class. This is the second class of Management Accounting and it is based on the chapter Capital Structure. In the first class, we had read about what is capital structure, capital gearing, optimum capital structure. In this class, we shall discuss what are the factors that are responsible for capital structure, or before designing the capital structure, what factors the promoter of the business, the company, must take into account. First, the size of the business. If the company is a small company, is a low scale business, then it is difficult to get loan. It is really difficult to get a long term loan. If the bank agrees again, they charge high rate of interest. So low scale of business, high rate of interest, strict repayment conditions are very much important for small size company. In case of a very big size company, very prosperous company, this type of difficulties does not arise. So the small size company, they are limited by all these factors, and this difficulty, it limits their ability to grow their business. Then the second point is your credit worthiness. If you are going to the bank will check your credit rating. If you have a good credit rating, then it is okay. If your credit rating is not good, then the bank generally hesitate to give you loan. And if the company has a past record of timely payment, repayment of loan, they have a past record, they had taken loan and they had already paid the loan in time. So this is their past record. Then it is easier to get the loan. Similarly, the bank always see the project evaluation criteria is important for extending the loan. So good credit rating, past record of timely payment, project evaluation are very important for designing the capital structure, right? Then let us come to the third point. The third point is your cost of capital. As you know, the capital structure means it is owned capital and borrowed capital mixed together. A part of the capital is equity, retained earnings, a part of the capital is preference, debenture, term loan, etc. The company will have to calculate the overall cost of capital. How much is the total cost of capital on a weighted average basis? And if the rate of return on investment is greater than cost of capital, then it is good or it is profitable to take the loan. Suppose the company has a equity share, preference share, debenture. Equity share are the ordinary shareholders and they bear the maximum risk. Preference shareholder gets fixed rate of dividend. Debenture always carry a fixed rate of interest. And all these are having cost. And you can calculate the overall cost of capital. This we have read in the cost of capital chapter. If the overall cost of capital is say 10% and rate of return on investment, that is your internal rate of return, that is the return what a businessman is getting on investment, maybe it is 15% or 14%. That means rate of return is higher and cost of investment is lower. So it is a good decision to take a loan. Suppose I have taken a loan for the company and paying 10% interest on 1 crore. That is 10 lakh is the interest. But if I invest 1 crore in the business, I will get 14 lakhs of rupees as return. That means 4 lakh I am getting more than the interest. So it is a good decision to take the loan. If the reverse is the case, interest to bank is 14 lakh, but I am getting from the investment only 10 lakh. So I will be paying to the bank more than what I am getting from the business. In such case, it is not advisable to go for the debt. Then you come to the fourth point. This is your capital market. All of you know that capital market is very volatile. Sometimes it goes down, sometimes it goes up, and the market is volatile, that sometimes the company is unable to raise the funds due to risky model of business. And the management has to raise funds from the debt market. It is not easy to raise the fund by issuing equity share. Therefore, the management always try to take loan for financing the project. This is again making the things a little bit risky. Therefore, capital market is also a factor to be considered in capital structure. Then the next point is your company's growth. A company's growth plans can affect its capital structure. The high growth company require more funds. Hence, they have to depend on the debt financing. A low growth company may depend on equity. Those companies which are very high growth, they need the capital time and again. And it is not possible to raise the capital through equity share time and again. Therefore, they generally depend to some extent on the debt financing. So company's growth is the most important part of the capital structure decision. Then comes the sixth point, that is profitability. If the company is profitable, then banks are also willing to extend the loan at a reasonable interest. High profitable company may rely less on debt and more on equity financing, because when the company issues share to the public always study the balance sheet, the financial performance, and if they see the company is a very good profitable company, generally the shares are sold, and if the company is not profitable, then it is difficult to raise the funds by issue of equity share. In such case, the company has to rely on the debt financing. Then we will come to your asset structure. If the company has a lot of tangible asset like land, building, equipment, etc., it is may be able to borrow more funds at a lower rate of interest than a company with few tangible assets. If the company has a lot of tangible asset, the bank keep it as a mortgage, either primary mortgage or secondary mortgage, to advance the loan. If the asset base of the company is very good, then generally the bank can extend loan at a lower rate of interest. If the company does not have a good asset structure, then the company cannot afford a lot of security to the bank. In such case, bank charges more interest because bank has to bear the high rate of risk. Then we will come to the next point, that is your tax policies. So tax savings on interest and debt. If the tax policy is favorable, then it is easy to operate or take the loan. Each loan the company takes, it saves taxes. Suppose a company has 1 crore loan and it pays 10 lakh as interest. The interest is debited to the PL. As a result, the taxable income of the company reduces. In this way, the tax planning can be made with debt as a debt interest. So government tax policy is very important for the growth of business. Then comes the competition. Competition can also affect a company's capital structure. Generally, the company follow the competitors in respect of source of finance. If a competitor has a debt and equity ratio 2:1 or like that, then generally the other company follows the competitors. When competitors are highly leveraged, that means high debt company, a company may try to increase its own leverage to remain competitive. Suppose A Limited, has a debt of 10 crore and equity of 10 crore, 1:1. And B company is a competitor. The B company will also follow the A company so far as capital structure is concerned. So, competition is one of the most important factors in designing the capital structure. So, capital structure depends on all these factors, and before designing the capital structure, the company must look after all these factors to have an optimum capital structure. We have discussed the optimum capital structure in class 1. Optimum capital structure is an ideal capital structure. the low interest capital structure, the low cost capital structure, and our total objective is to reach at the optimum level. Friends, if you like the video, please subscribe, offer your comments. We will come out with the total course on capital structure with number of classes. Thank you. Meet you again in the next class.